geopolitical tensions in the Korean Peninsula. We've had quantitative easing coming to the fore. Portugal now being forced to perhaps take a bailout. Ireland taking a bailout earlier this week. Things have changed quite dramatically, and some would argue that markets have been relatively resilient despite all the troubles. Is this your notion as well?
You know, I think it's a lot more simple than that, and maybe it's because of the way I feel. I think everyone's tired. You know, you talk to clients, you talk to stockbrokers, you talk to proprietary traders. Some of it's the end of the year. People just don't want to take a lot of risk at this time of the year. But I think some of it is genuine fatigue about trying to call a market that's very difficult to predict, given the uncertainties around the macro situation, but the positive signs from quantitative easing. So I think what you're seeing with North Korea and Portugal and Ireland actually isn't that relevant in itself, but it's symptomatic that the markets have fallen on the back of it because no one's really got conviction. And you can see it in market volumes. Market volumes have almost completely dried up. They tried to, you know, the market and the volumes tried to have a rally in the first couple of weeks of November, but it felt a little bit like, you know, an athlete or whatever at the end of a marathon where, you know, he tries to have a final dig at the finish line and just completely fell over. And that's what we're feeling right now. There feels like a bit of exhaustion out there in the market.
Of course, we had that nice rally in September through to October as well. As you said, moving sideways really for November. What sort of catalyst are we looking for to drive these markets higher? Do you think they deserve to go any higher? Should we be seeing a bit of a pullback at these levels?
Yeah, I think the most important thing at the moment is China. You know, if you look at our global strategist, particularly our emerging market strategist, Jonathan Garner, he's got quite a lot more cautious on equities. And the primary reason is he is concerned that China is seeing an inflation problem creeping into its economy through the real estate market and through the commodity market, and they want to squash that. And so they're kind of putting their foot on the handbrake a little bit. Last time that happened, it was a material event for global equity markets. We all know how dependent global equities are on growth in the world. Growth in the world is being driven by China. You take that away, there's very little reason for markets to go any higher. And
we keep hearing reports that China is concerned about the inflation coming through, and this is why they are trying to put a cap on things. And we've seen the bank's reserves ratios increased many times this year. It seems that they're going to be adopting the strategy, but it's not enough to cool down the economy. It seems that it is steaming ahead, even in the property sector, because the underlying demand is real demand. It's not artificial.
Yeah. But the problem is that it's going to start hitting the really politically sensitive part of the population. So I think house prices, you know, that causes some effect on the lower income groups. But, you know, a lot of those people rent properties. But when it starts hitting food baskets, which is really where a lot of the inflation pressure is being felt at the moment. I mean, if you just look at the price of wheat and corn and that globally, we're back to prior sort of peak commodity bubble highs. And that stuff is what's going to start feeding into the inflation numbers from next year. And I think I commend China to try and be predictive about that. The problem is that the developed markets, the US, the UK, they're in such trouble, they can't afford to put up interest rates or take away the sort of the bottle of quantitative easing.
What sort of impact could this have on commodity prices going forward, and by implication our markets as well?
I think they should come off. I mean, it's kind of a short versus long-term phenomenon. I think in the short term, commodity prices have every chance of coming off a bit. Longer term, I think the demographic dividend of India, China, and whatever will continue to drive commodity prices higher. But it feels like they've got a bit hot lately, and some of it's investment demand. You know, the people who haven't been putting money into equities because they haven't really liked equities, they've kind of been chasing commodities. And we've seen that. I mean, you look at the ETF flows, a lot of it is going into the commodity business at the moment.
So basically there's a big element of speculation as well. So even if we do see a bit of tightening coming through in China, the speculators will still be there because there's a lot of negative sentiment surrounding where the dollar is going to be going, or printing of the money, and of course Eurozone debt. So maybe that will keep perhaps even the precious metal side of things propped up.
No, speculators will run for the hills. Once prices turn down, speculators are gone. So that's, you know, that's the trick is are we seeing just a little rollover like we saw in the middle of this year, or could this be something more serious? Now, fortunately, equity valuations are not that scary. So it's not like you're buying equities at eye-watering valuations. However, if you don't get an earnings recovery next year, consistent with the kind of momentum we've seen this year, I think equity investors will be disappointed.
I mean, looking at our markets at the moment, we're trading on a PE of close to 17. Going into 2011, do you think we're going to see the earnings that will support the markets at these levels and perhaps bring that PE ratio down?
We don't. I mean, we think returns next year for the equity market will be about 10%. I mean, that's about as good a number as you'll probably get from anyone at this point. I think the challenge is that what we're starting to see is people who are trying to justify the market levels where they are right now are pointing to how cheap South Africa is versus other markets. And we've gone away from the discussion of how cheap we are in absolute terms. So your question is 17 times, is it cheap or expensive? Well, it's very expensive against history, but it's quite cheap against Russia or Brazil. You know, so it depends a little bit on whether you believe emerging market investors have to be invested, and therefore South Africa still holds some promise to them because it's cheaper than other markets.
So perhaps if a lot hinges on China, as you alluded to earlier, then what sectors would you be investing in? I mean, obviously resources is something that you've really got to be cautious about going forward.
We like the consumer space in South Africa, particularly some of the consumer staples names. And the reason is, you know, our belief is that the high-end consumer in South Africa is troubled. They've got too much debt, their house prices isn't going up, their wage increases aren't that high. The middle income with grants and jobs and wage increases is actually doing okay. And so we, you know, the play on that we think is more the kind of consumer industrial stocks, Tiger Brands, you know, that kind of thing.
How about flows into bond markets? Because we've seen those dwindling a little bit as the year draws to a close. Our bond market looking a little bit inflated as well at these levels. Are we still seeing them coming into South African equities at this stage though?
No, not really. I mean, the South African equity inflows was a 2009 story. 2010's been a bond inflow story, and both of those have dried up, which is why I think, in big reason why you're seeing the rand, you know, some of the appreciation of the rand come off here. Some of it's, you know, what you were mentioning earlier,
South Korea, yeah.
But some of it is just flows have stopped.
What about taking money offshore? I mean, you're talking about, you know, South Africa being cheap or expensive relative to other nations, you know, looking at what we're seeing in the US and the likes of Europe. A lot of opportunities there, some would say.
I think the biggest arbitrage, if you like, in the world at the moment is all this money is flowed into emerging markets. It's made emerging market stocks quite expensive. You can buy some very good emerging market plays in developed markets listed on the London or New York Stock Exchange that have good emerging market exposure for much cheaper multiples. That's where I'd be looking.
Just going into next year, what do you see as the main risks to those markets? You've talked about China. Do you think that Europe is still going to be an issue next year?
Yeah, I don't think we get, I mean, how do you get out of a debt burden? You've got to grow out of it. There's no growth. No one wants to raise taxes because you kill your economy. Ireland's a classic case. I don't see it going away for some time. Eh?
But at what stage do the markets look past that, knowing that it is there?
They're looking past it at the moment. I think the concern more is that they start looking towards it again. You know, we've sort of forgotten about it. Ireland's reminded us of it, and look how the market's not taking it so kindly.
Chris, thank you very much. Unfortunately, we have to leave it there.